So we've talked about how changes in interest rates can affect a bank's net interest income or the economic value of its equity, and how banks will try and reduce the earning gap and duration gap to mitigate those risks, and also the cash flow gap when we have different maturities for the bank's financial assets and financial liabilities, and how that can lead to a cash flow shortfall if they're not properly managed. However, we haven't talked about the liquidity gap. Now, the liquidity gap is unlike these three gaps in that it's not really a mismatch problem of assets and liabilities not being properly matched. The liquidity gap is we're assuming that there could be some scenario where one or more sources of funding that the bank relies on suddenly become unavailable due to this unexpected freak event. Okay. Now, this could be catastrophic to the bank. It could result in the bank's failure. Okay. We're talking about insolvency here. Think about the 2008 financial crisis. Okay. Banks relying on securitizations, mortgage-backed securities as a source of funding. Suddenly, nobody wants to buy mortgage-backed securities anymore. Okay. Because they found out that a lot of them were holding garbage mortgages. Okay. So suddenly, this source of funding dries up. And that could lead to the bank's failure if there's not some kind of contingency plan for an alternative source of funding. So we're thinking about with the liquidity gap, there's some kind of liquidity event, some kind of scenario that could happen and be catastrophic to the bank. And so the bank is trying to be proactive and think about, okay, well, what are the hypothetical things that could happen? Is it going to be the repo market seizes up? Is it going to be that mortgage-backed securities and the securitizations, like they can no longer sell asset-backed securities at all? Could potentially happen here? What are the hypothetical scenarios? Okay, what is the worst-case scenario? And then come up with a contingency plan. Okay, so this is how they're going to address this liquidity gap. What could happen? What could go wrong? And then if that does go wrong, what's our contingency plan? What are we going to do if we can't sell mortgages? If we can't, what are we going to do to come up with money? So how are we going to weather the storm, so to speak? And then once you've got this contingency plan, you've got these hypothetical scenarios, try and monitor some type of indicators so that you can see ahead, okay, trouble on the horizon. It looks like the worst case scenario could actually be coming to pass. What are some indicators? Credit rating downgrades. For example, we think about the 2008 financial crisis, increases in defaults on mortgages. Okay, so there were some people monitoring that, and some people made a lot of money from monitoring that and realizing that there was a storm brewing. Okay, so with liquidity gap, again, it's not so much about matching assets and liabilities like we talked about with the other gaps and is as part of gap analysis and ALM, but we're thinking about this extreme hypothetical scenario that could happen. And so the bank could do things like value at risk analysis, which we'll talk about, but they're trying to avoid going under if this catastrophic scenario comes to pass.